Hello, my name is Dan Nelson. I'm with Southwest Funding here in Albuquerque. Today I'd like to talk to you about credit scores and how they relate to mortgages and getting a mortgage for the purchase of your new home. In the mortgage industry, we do use 3 credit scores, those being from the 3 major credit reporting agencies, TransUnion, Equifax, and Experian. When an underwriter is looking at a file, they're going to use your middle credit score, or if there's multiple borrowers, they're going to use the lowest middle credit score of the parties involved. Credit scores drive the interest rate, the terms, and the programs that you are going to have available to you out there. So obviously, the higher or better your credit scores, the better the terms and the more programs you're going to have available to you. However, when you do come in to see us here at Southwest Funding, we're going to sit down, we're going to go through your credit report and figure out, is everything on there accurate? Is it being reported accurately? And is it your accounts when it comes to the credit? With today's modern technology and cyberspace out there, it's not uncommon to come across customers who come in and there'll be things on their credit report or credit history that they're not familiar with, that who knows how it got there. So coming in here, sitting down, reviewing your credit report is a very important step in the process to figure out where you're at and if you need to change or make any updates or improvements on your credit report. Thank you for watching today. If you have any questions or would like more details, please visit us on our website or give us a call. Hello, my name is Dan Nelson. I'm with Southwest Funding here in Albuquerque. Today I wanted to touch on some of the highlights in the pre-approval process when going out and getting ready to purchase your new home. In the pre-approval process, you want to pick out a mortgage professional, whether it be a mortgage banker or broker, that you're comfortable with, and sit down with them and get a level of comfort with them, as they're going to ask for some information that's very, very personal and somewhat can be, you feel, the evasive part of it. In the pre-approval process, your mortgage professional is going to ask you for proof of income. That typically being 1 month worth of pay stubs. If you're paid bi-weekly or bi-monthly, typically your last 2, or if you're paid weekly, your last 4 pay stubs. They'll also ask for copies of your last 2 years worth of W-2s and tax returns. On your tax returns, that does include all the pages of your federal returns and the schedules. Sometimes people will have some self-employment income, maybe some rental properties out there, or some unreimbursed business type expenses on a Schedule A. So these are important when proving income and when it comes to your underwriter determining your debt to income ratio. In addition, they're going to want a proof or source of where the down payment is going to come for, or your closing costs. Where is that going to be coming from? So they're going to ask for 2 months worth of bank statements, and if you're using investment accounts, typically the last 3 months worth of investment accounts. Also, something to consider when turning in bank statements is large deposits. Underwriters are going to go through there and look at all the deposits. If the deposits are direct deposits or deposits from your employer, no problem. But if there are some different deposits in there, large deposits per se, anything maybe $100 or more that's not payroll or employment related, the underwriter is going to ask for an explanation of where did that money come from, and then whether or not they can use that as part of your down payment or funds for your closing costs. The next thing that'll happen when you're doing a pre-approval is credit report. They're going to pull a credit report, and on a credit report in the mortgage industry, we pull from the 3 major credit reporting agencies, that being TransUnion, Equifax, and Experian. Underwriters look at your middle credit score from the 3 agencies, and if there's more than 1 borrower involved, they're going to look at the middle credit score or middle lowest credit score of the borrowers involved. On the credit reports, they're also going to ask for explanations of any maybe credit hiccups, lates, collections, that type thing in the last typically 24 months or 2 years. So if there's some late pays, maybe some collections, past dues, anything like that in the last 2 years, you're going to want to make sure you do a written explanation of what those were and maybe the circumstances surrounded those late pays. If there's inquiries in the last 120 days, underwriter is going to ask for a written explanation of what those inquiries for. That is very important in determining your debt to income ratios, because sometimes an inquiry may be on there and you've acquired a debt that is not being reported on your credit report yet. However, it's still a monthly obligation, and the underwriter needs to take that into account when figuring your debt to income ratios. And additional items that are needed with the new Patriot Act being what it is, they're going to ask for a copy of your driver's license and a copy of your Social Security cards for the Patriot Act and proving who you are. Yes, you really are who you say you are. These are just some of the items needed to get the transaction started. Yes, there'll be additional conditions and items the underwriter is going to ask for down the road. But in the pre-approval process, items you're going to need: pay stubs, W-2s, tax returns, bank statements, investment accounts, evidence of any large deposits, credit report with explanation on late pays or adverse credit in the past 2 years, explanation of any inquiries in the last 120 days, copies of your driver's license, Social Security cards. And that typically will cover the items you need to get that pre-approval letter or get the ball rolling to the purchase of your new home. Thank you for watching today. If you have any questions or would like more details, please visit us on our website or give us a call. Hi, my name is Dan Nelson. I'm with Southwest Funding here in Albuquerque. Today I wanted to take a couple minutes of your time to go over the many purchase programs that are out there and available to home buyers today. Although there are way too many of those to probably cover today, I'm going to touch on some of the more common or more popular ones. The first one is the FHA purchase program. On FHA, you're looking at a 3.5% down payment needed. Also, on FHA, there's more leniency when it comes to credit or FICO scores. You're still getting the very good rates, even if the credit scores are in the 600s or even in the 500 range. It allows for you to get competitive rates and allows for underwriters to go in and do some manual underwrites and look for compensating factors on lower credit scores. So FHA can be a very good purchase product with a 3.5% down. Also, there's the conventional mortgages out there. On conventional, the difference being is you need 5% minimum down payment. You can always do more down payments than what I'm talking about today, but you need a 5% down payment for conventional, and typically the credit scores need to be a little bit higher. Because in conventional lending, the interest rate is based off credit score and loan to value or amount of down payment you're putting on it. The more down, the higher your credit scores, typically the better your interest rate's going to be. Also, we have VA loans for veterans. On a VA loan, there's a 0% down and no mortgage insurance. There is a VA funding fee, and that funding fee is added to the initial loan amount and figured into your monthly payments. However, no mortgage insurance is required on VA loans. The next one I'll touch on is the Mortgage Finance Authority loans out there, or down payment assistance programs. Those are used in conjunction with FHA loans. So you, on an FHA loan, are putting 3.5% down. If you use a mortgage finance or MFA loan, then you're only required to put $500 down and a total of a minimum of $1,000 towards the transaction, which is your $500 down plus your prepaid closing costs, taxes and insurance and what have you, or other closing costs. On the Mortgage Finance Authority or MFA loans, Those are typically a second mortgage, and you need to pay those back. But in certain cases, based on the location of the home or income limitations and that, those can sometimes be done as a grant where you do not have to pay that back. Also, when it comes to down payment assistance programs, there's the Good Neighbor program. The Good Neighbor program is for firefighters, police officers, first responders, and those homes have to be in certain neighborhoods, and there are some income limitations on that as well. But again, down payment assistance, and those are typically, the down payment on those are typically in the form of a grant where you do not have to pay those back based on how long you live in the home and that type thing. The HERO program, again, for police officers, firefighters, first responders, and teachers. This here program does not have as many limitations on where the home is located or the neighborhood the home is in. It has some limitations on your income and the price of the home, how much the home costs. And those can and do change from time to time, so please check with your real estate or mortgage professional on what those limitations are. Also becoming a little more popular here in New Mexico, because we are somewhat of a rural state, is the USDA programs. On USDA, it allows for a 0% down, but the property has to be USDA eligible. And what I mean by that is you can go to the USDA website, type in your property address, and it'll tell you if it fits in the tract or the area where USDA loans are eligible. So typically your rural areas, which is a lot of New Mexico. Another great program. Does have some limitations on income and credit, but all in all a good program. The last program I want to touch on is one of my favorite. It's the Home Path program. The Home Path program is for the purchase of a Fannie Mae serviced home, or a home that has a mortgage on it that's serviced by Fannie Mae that has gone into foreclosure. On this particular program, you're allowed to do a minimum of 3.5% down. There is no mortgage insurance, which is a difference between the Home Path and, say, FHA or conventional. So no mortgage insurance will save you, could be thousands of dollars a year in mortgage insurance by going Home Path. And then also no appraisals are required on these homes. So the homes are truly sold as is or in the condition they are. So ask your real estate professional if they're familiar with Home Path homes, and if they can maybe look for some Home Path eligible properties in the area or price range that you're interested in. You can also go to the website Home Path and look on your own for homes in your area or price range that are Home Path eligible, and look on those on the internet. So those kind of cover some of the programs that are out there that I wanted to touch base with you. There are even more purchase programs out there that are available that I don't have time to get to, but when you sit down with your real estate professional or mortgage professional, make sure they tailor-make your mortgage program for you, your needs, your income or credit situation. Thank you for watching today. If you have any questions or would like more details, please visit us on our website or give us a call.